there appears to just be quite a profound awakening of the desirability for electric vehicles. And I mean, to be totally frank, it's caught us a little bit off guard. The probability of collision for a customer using a safety score versus not is 30% lower. It's a pretty big difference. It means that the product is working and customers are responding to it. We entered the insurance market kind of unintentionally, I would say. Our customers were coming to us complaining that the price of traditional insurance was too high. And part of our journey here at Tesla is we want as many people as possible to be able to afford our products. That's extremely important to achieving the mission of the company. And if you look at the price of insurance as a percentage of what somebody's monthly payment is, it's quite high. And we spend extreme amounts of effort in manufacturing to take $5 of BOM cost out here or $10 out somewhere else. If we can get $5, $10, $20, $30 out on a monthly payment, you can calculate what that means in terms of reduction of the price of the car if you finance it. And the leverage of improving insurance cost is huge in terms of affordability.
Hey, I'm Stephen and this is Solving the Money Problem. If you're new, welcome. If you're not, welcome back. So in this video, I've cut together the absolute highlights of Tesla's Q3 2021 earnings call, Tesla's multi-record breaking Q3 earnings call to be specific. Check out the timestamps in the description. I'll also be sharing my thoughts and comments at the end of the video. I really do recommend you guys watch these highlights if you can't watch the entire earnings call. There was so many gems in there, including some really fascinating insights into Tesla's demand, their plans for next year, and some really cool new information about Tesla insurance and the Tesla safety score. So with that said, let's get into the highlights. If you love crypto, stocks, and free stuff, or just want to help out the channel, check out these great offers. BlockFi are launching the world's first Bitcoin rewards credit card. People in the US can earn 1.5% Bitcoin back on every purchase with no annual fee using the BlockFi Bitcoin rewards credit card. Check out the link in the description. And for a limited time, you can get up to $250 in crypto bonuses when funding a new account on BlockFi, where you can use cryptocurrency to earn interest, borrow cash, and buy or sell crypto. If you want your free crypto, use the link in the description. And if you'd like up to 2 free stocks, check out the link in the description to WeBull. If you open a new account, you'll get 1 free stock valued up to $300 just for opening an account. And if you make an initial deposit of $5 or more, you'll get a second free stock valued up to $2,000. Seriously. Free stocks? Yes, please. And finally, if you're in Australia, the UK, or New Zealand, you can get a free stock with stake, also linked in the description. Thanks so much for your support, guys. Let's get back to it.
We're continuing to make great progress as a company, setting new records on each of the most important financial metrics for Q3. We were also able to achieve an annualized production run rate of over 1 million cars towards the end of the quarter. Additionally, we have made great progress increasing production volumes of Model S, but based on demand, we are targeting to exceed historical production levels. Due to part shortages and logistics variability, we have not been able to run our factories at full capacity. It's important to note that while we have roughly doubled deliveries year to date, this has been exceptionally difficult to achieve. Despite these increases in production and generally higher prices, our backlogs are continuing to grow and average customer wait times are extending. Financially, our auto gross margins reached 30.5% on a GAAP basis and just under 29% excluding regulatory credits. This benefit primarily comes from higher volumes, particularly out of the Shanghai factory, increased mix of the Model Y, and we have made good progress increasing Model S volumes. The Model S has now returned to positive gross margin, and we expect this to increase with higher production and the ramp of Model X. As a result of the great progress on margins, volume, and appropriate management of overhead costs, we were able to achieve an operating margin of just under 15%, exceeding the long-term guidance we've laid out previously. On cash, we generated record operating cash flows of $3.1 billion and continue to invest heavily in the build-out of manufacturing, supercharging, and service capacity. We also continue to retire high-interest rate debt, including the early settlement of our 2025 senior notes of $1.8 billion during the quarter. As we look forward, we are clearly quite a bit ahead of the pacing required to achieve our target annual growth rate of 50% this year. We are also nearing assembly of our first production cars in Austin and Berlin.
What is Tesla's goal for vehicle production capacity for the 4 current factories, Fremont, Shanghai, Austin, and Berlin, by 2024?
Yeah, thanks, Martin. Our goal as a company here is to grow on an average pace of 50% per year. And so you can extrapolate that out. There may be some periods of time in which we're well ahead of that. There could be some periods of time, despite best efforts, where we're slightly lower than that. But that remains the long-term goal of the company. In Fremont, we're continuing to push the boundaries of what's possible there. Over the last 12 months, we've done about 430,000 cars of production. And, based upon everything that we know in the factory, where the bottlenecks are, what the potential is, we're targeting to increase that another 50%. As we look towards Shanghai, we're continuing to push the boundaries there, and we continue to ramp production there as well. So most recently, the ramp of the Model Y, which was our biggest contributor of volume in Q3, we'll continue to ramp that factory. And our plans there with time are to keep growing the capacity in that factory. Austin and Berlin are interesting factories because our first iterations of capacity there are on Model Y. But we've intentionally set these factories in locations in which they have a quite significant amount of land and ability to expand. We're trying to get to 5,000 cars a week as soon as we can, and then we'll continue to push beyond that, potentially even getting to 10,000 cars per week at those factories. And then we'll add Cybertruck here in Austin and continue to grow from there. So, our goal is to get to millions of cars per year over the next couple of years, and then ultimately in the long term, be able to achieve 20 million cars per year. We're going to grow as quickly as is feasibly possible with an eye towards a 50% annual growth rate. Over the last year, we've grown our physical footprint of service centers by 35%. We've grown our footprint of mobile repair by over 40%. But I think the most important part about all of this is, and we've said this on calls before, where the best service is no service. And so we have been incredibly focused as a company, both on the initial quality of our vehicles and reliability of our vehicles. And we've seen pretty substantial improvements in both of those metrics over the long term and over the last couple of quarters. Just one thing to add on supercharging. If you haven't experienced our latest iteration of battery packs that can handle fast charge rates in combination with our 250 kilowatt charging stations, is pretty incredible. And this is a really important component to supercharging capacity, because the faster you can charge, the more charge sessions that you can have on an individual post, the better the customer experience is as you're going on a long-term journey, because your supercharging times are lower. Yeah, pricing has been a really difficult thing for us over the last couple of quarters. And where part of the challenge is, the great thing that we're seeing in the space right now is there appears to just be quite a profound awakening of the desirability for electric vehicles. And to be totally frank, it's caught us a little bit off guard. And that kind of awakening and change in consumer sentiment, I'm sure there's lots of reasons that go into it, but folks want to buy an electric car and folks want to buy a Tesla right now. It's very exciting for us. At the same time, we have installed capacity to build more cars, but we're constrained by a number of dynamics, as we've talked about in great detail. And we are putting in extreme effort to build as many cars as we possibly can. It's hard to overstate how extreme the efforts are. It's quite the grind.
Way, great to hear there's a team at Tesla, not just a one-person show. I want to drill down a bit more.
So it remains our target in both Austin and Berlin to be able to build our first production cars before the end of the year. We've talked about this a bit, the unknown unknowns, new factories, new vehicle designs, new technologies, new locations, new teams. So, there's quite an execution journey ahead of us. But that remains our target, and all of our plans are oriented around that. We should not expect for us to deliver cars by the end of 2021 from these factories, even if we do produce some. We are carrying some amount of cost associated with the factories today. And so the incremental cost associated with turning the factories, it's not 100% of a factory, if that's what you're getting at in your question.
Yes. Yep, that's what I was getting at.
Yeah, we also actually saw a very similar dynamic to this when we were launching Model S earlier in the year. So, when a product starts launching, and then cost of goods sold starts to activate, depreciation starts to activate, there's a bit of a movement in the P&L as to where that cost resides. So yes, to some extent, Brandenburg and Austin costs are already flowing through our P&L, but we still need to continue staffing and ramping and incurring all the operating costs associated with a factory that we're not spending right now. So, at the highest level here, we entered the insurance market kind of unintentionally, I would say. Our customers were coming to us complaining that the price of traditional insurance was too high, and it was reducing the affordability of a Tesla. And part of our journey here at Tesla is we want as many people as possible to be able to afford our products. That's extremely important to achieving the mission of the company. And if you look at the price of insurance as a percentage of what somebody's monthly payment is, it's quite high. And we spend extreme amounts of effort in manufacturing to take $5 of BOM cost out here or $10 out somewhere else. If we can get $5, $10, $20, $30 out on a monthly payment, you can calculate what that means in terms of reduction of the price of the car if you finance it. And the leverage of improving insurance cost is huge in terms of affordability. And at Tesla, because our cars are connected, because they are essentially computers on wheels, there's enormous amounts of data that we have available to us to be able to assess the attributes of a driver who's operating that car and whether those attributes correlate with safety. So we've been spending our time looking at hundreds of different variables and also looking at billions of miles of driving history. And we've been able to fit a model that is able to predict with decent accuracy the probability of collision over a period of time. And from that model, being able to predict frequency of collision, we can then align that against a price curve. And we can have individualized pricing integrated into the car, integrated into the app, integrated into that customer's experience with a feedback loop back to the customer on how they are driving after every drive, the attributes that they were successful on or unsuccessful on, and the tips of things that they can do to improve their safety. So that's what we've developed. We then included the safety score as a part of the FSD beta enrollment program, where we have almost 150,000 cars currently using the safety score, and I believe the latest data is over 100 million miles of driving. So we've been able to go back and analyze that data, and we've learned two things coming from that. The first is that the probability of collision for a customer using a safety score versus not is 30% lower. It's a pretty big difference. It means that the product is working and customers are responding to it. The second thing that we've looked at is what is the probability of collision based upon actual data as a function of a driver's safety score. And that is aligning with our models. Most notably, if you're in the top tier of safety compared to lower tiers, there's multiple X difference in probability of collision based upon actual data.
Where to begin? First of all, this was the first Tesla earnings call in which Elon Musk made no appearance. It's great to see. This is a very bullish signal for the company. Elon Musk delegating, focusing on more important challenges and problems, and not needing to micromanage the call. The Tesla team did a fantastic job with this earnings call. Tight, efficient, very productive. Round of applause. And as we heard, Tesla broke records on every meaningful financial metric. Not surprised, they crushed Wall Street expectations, even beat my own expectations, so they're absolutely killing it right now. It is incredible to watch this company execute despite all of the headwinds at this point in time. Tesla confirmed that their annualized rate of production has now exceeded 1 million units per year. Very impressive, but they're just getting started. We also learned that there's been great progress ramping up the new revised Model S. just started doing the same with Model X. This is going to have a massive increase on margins, a very positive increase on margins in the coming quarters. We also heard that Tesla, based on the amount of demand, believes their sales of the Model S and X will actually exceed their historical highs. This is very bullish for the company. These vehicles are absolute money printers. Another extremely bullish signal for the company was the fact that we learned that Tesla's factories throughout the quarter weren't actually running at capacity due to massive logistics challenges and supply chain shortages. Translation: if these headwinds weren't present, and they won't last too much longer, Tesla would have produced and sold way more vehicles, made way more money, and absolutely destroyed all the records they posted this quarter anyway. It only gets better from here. Seriously, the fact that Tesla had major logistics challenges and part shortages yet still crushed every prior record is just incredible. And speaking of incredible, Tesla also crushing their gross automotive margins in excess of 30% gap automotive margin and getting close to 30% not including regulatory credits. This is industry leading stuff. Oh, and spoiler alert, Tesla's not done. I expect that these margins over the long term will march steadily towards 40%. Unheard of in the automotive industry. Tesla also hit it out of the park with almost a 15% operating margin, which just blew my brain. And once again, Tesla isn't done here. They've exceeded their long-term goal for operating margin, yet they told us on the call that they expect that this can continue to climb over time. This despite heavy investments in manufacturing, charging, and service. Tesla also once again reiterated their goal. They're on track. They're already in excess of growing their annual deliveries by 50% this year, and they're expecting to stay on track for that goal of growing their compound annual rate of deliveries by more than 50% for many years into the future. And the final insight we heard from Tesla in their prepared statements: Berlin and Austin both expected to begin production, but not deliveries in 2021. Some great questions asked via say.com as well. The first around Tesla's production capacity. Somebody wanting to know how many vehicles per year might Tesla be producing around 2024. Instead of giving a direct answer, it's like, bro, just do the math, right? 50% compound annual rate, at least year over year, you can extrapolate from there. So let's do exactly that. We'll just use some nice round numbers. Let's say that Tesla delivers 1 million vehicles this year, 50% more next year, that's 1.5 million in 2022. 2023, that's 2.25 million. In 24, that's 3.375 million. In 25, that's 5 million vehicles delivered. Of course, nobody believes Tesla's going to achieve this, except Tesla. We also heard that Fremont produced 430,000 vehicles in the prior 12 months, the last 4 quarters, and remember, this continues to increase. And we also got confirmation once again that Tesla believes that they can increase their output at the Fremont factory, which by the way is an absolute clusterfuck. Tesla bought a factory at fire sale prices years ago. It's not a clean sheet of paper design, so they're doing the best with what they've got. Even so, they believe they can increase their production capacity a further 50% from where we are today. More interesting still, the plan with the Berlin and Austin factories is to get to production capacity of up to 10,000 vehicles per week in their initial stages just with Model Y production. Just in case you suck at math, that's over 1 million vehicles, just Model Y vehicles from the Berlin and Austin factory in phase 1. Then we heard that Cybertruck capacity will be in addition to that at the Austin factory. And then the big kicker, which kind of obvious, but just in case you've never heard it explicitly stated from Tesla before, the amount of land purchased at the Berlin and Austin site is far in excess of what Tesla needed in those initial stages, allowing them the capacity to massively expand production over the long term. I'm going to say it again, I personally believe that between Shanghai, Fremont, Berlin and Austin, Tesla per year ultimately will be able to produce at least 5, maybe up to 7 or so million vehicles per year. We also heard a great quote on the call: the best service is no service. Tesla really focused on quality and reliability of their vehicles. Some hugely important insights from Tesla Insurance and the recently launched Tesla Safety Score. I mean, I hate to be that guy, but I literally called this almost 2 years ago in my Tesla Insurance video. Feel free to go back and fact check me. Tesla now collecting data, the goal to provide customized insurance quotes for people based on their own driving behavior with access to data that no other third-party insurer can access because they don't have the telemetry that Tesla can collect from their own vehicles. In addition, Tesla now launching their safety score to over 150,000 drivers, teaching these drivers how to get a higher safety score, almost gamifying safe driving. And the end result of this, Tesla already has enough data, over 100 million miles of data, to confidently state that the likelihood of a collision from a Tesla driver who's using the Tesla safety score is about 30% lower than a Tesla owner who is not using the safety score software. In other words, this software is literally training and teaching Tesla drivers to become safer. Think about the implications here. They're enormous. And this is also something that I called a few weeks ago when safety score dropped, just pointing that out there because, hey, I make these predictions for a reason. And let me point this out for the 69th quadrillion time here. There'll come a point in the future where practically everyone that owns a Tesla vehicle will be using the Tesla insurance product. Nobody is going to be able to compete on price. And you might say, well, Stephen, what about the really unsafe drivers who are effectively being subsidized by safe drivers today? Won't they get a better rate because the other insurance don't have the data to know they're a fucking terrible driver? Well, here's the thing. Tesla's active safety features, their full self-driving software is improving exponentially over time. There'll come a point where this software gets so safe, even the worst of drivers won't be that much of a liability to Tesla because they won't be doing most of the driving. And even if they drive like a complete and utter moron, the software is going to make them much safer than average anyway. There was also an extremely snide, rude remark from, let's just call a spade, a gigantic fucking wanker, just want to repeat that one, a gigantic fucking wanker named Brian Johnson of Barclays, who seems for some reason to be incredibly salty about Elon Musk.
Yeah, no, it's, by the way, great to hear there's a team at Tesla, not just a one-person show.
Seriously, what a gigantic douche lord. Why so salty, Brian? Oh, that explains it. One of the worst ranked analysts on tipranks.com, ranked number, get this guys, 7,389 out of 7,704 analysts on TipRanks. Worse than a coin toss success rate in his stock picks, his average return minus 4.6% over a 1 year period. And we can look at his ratings on Tesla stock, and this is a pretty easy tell that you're dealing with a brain dead moron in terms of an analyst. When you've got a buy rating on Tesla stock back in 2013, then a hold rating for a couple of years with Tesla stock in the 40s, 50s, high 50s, etc., then suddenly and inexplicably you switch to a sell rating despite the fact that Tesla's growing, crushing all their meaningful metrics, increasing production, Tesla stock effectively at the same price 4 years later, and you're still recommending people sell, you know that you're dealing with an absolute moron because there's no logic here whatsoever. It's still sell, 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 sell. Average profit on Tesla stock minus 99.7%. So that explains why this gigantic Johnson is so salty. Been dead wrong on Tesla stock, has a $300 price target. Tesla absolutely crushing it. Poor guy, look now, I don't want to be too hard. He probably didn't get enough love as a child, so I'm not here to hate, but I will call a spade, you gigantic fucking wanker. Anyone else get the feeling that Brian's strong emotions towards Elon Musk are clouding his ability to effectively and accurately judge Tesla the company? Or is it just me? Now, I wouldn't ordinarily lay the smackdown upon somebody quite so hard. However, going on a Tesla earnings call and then snidely insulting the CEO of the company knowing he's not on the call, just not on. If I invited a guest around for dinner and then the first thing that they did was took a giant dump on the table, I'd tell them to get the fuck out of my house. Of course, the folks at Tesla on the earnings call were far too polite to do that, but I'm just saying what everybody was thinking. What a wanker. The good thing is, feelings don't matter when it comes to Tesla earnings. Tesla crushed it on every meaningful metric, absolutely blew it out of the water, provided some great insights on the very first earnings call without Elon Musk, and I'm so pumped I don't think I'm going to be able to sleep tonight. Let me know in the comments below, what were your highlights from Tesla's earnings and the earnings call? And also, is there a bigger wanker on earth than Brian Johnson? I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. And don't forget the BlockFi Bitcoin Rewards credit card, where you can earn 1.5% Bitcoin back on every purchase. There's a link in the description. You can also earn up to $250 in crypto bonuses when funding a new account on BlockFi, also linked below. And finally, don't forget your free stocks with WeBull and Stake, also linked in the description. These great offers also help out the channel. Thanks so much for watching. Let me know your thoughts in the comments below. And of course, if you have any ideas for future videos, let me know. I read all your comments. P.S. If you're still watching, you're awesome. If you'd like early access, exclusive videos, regular Q&As, our private Discord server and more, consider supporting the channel at patreon.com/solvingthemoneyproblem so I can keep creating content for you guys. There's a link in the description. You can now also become a member of the channel for some exclusive perks. To learn more, click the join button next to subscribe. And don't forget to check out our merch store. Either way, the best form of support is you being here and watching, so thanks again.